Hey, and welcome back for another episode. So again, you are joined solely by myself. Matt is still away, but the podcast team have got a good episode for myself and you listeners and viewers today. So now this should be interesting because they've sent me over some questions for a Q&A, and they've sent them over pretty last minute to not give me any time to prepare. So yeah, this is going to be interesting to see how I do respond to these, but let's have a look through. Okay, right. So let's get on with these questions then. Now, with Matt not being on the podcast, no issue there. I do like the sound of my own voice, but I will try not to ramble on too much with these questions. I'm just looking through here, see if there's anywhere I'm going to go off on an absolute tangent. But yeah, let's see how it goes. I believe some of these questions were given to us by some listeners as well, apparently. So that is very, very good. But yeah, let's see what the podcast team have set me up for. Let's get going. So, first question I have here. How has the UK economy impacted the property market? Okay, good question. How has the UK economy impacted it? I think so far from what we're seeing, and I'll probably go from where Labour came into government, for example, because that was quite a big situation within the economy, which can even go, north or south sometimes. But in all honesty, it's been okay. So in terms of the impact the economy's had, I think overall, generally, it's been good. There's been some turbulent times with, the change of governments, change of prime ministers when the Conservatives were in power. And I think the stability and strength of the UK economy has helped the UK property market remain resilient as well. The property market's fundamentals are strong and, have remained strong over the past few years. There's been a supply and demand imbalance which hasn't changed, so lack of supply, high demand. We've seen, the regeneration going on in lots of cities. And overall, the property market has been in a pretty solid position. We did have mortgage rates obviously massively rise when we saw the Bank of England base rate rise over the past few years. But again, the property market wasn't massively dented by that. Unaffordable levels in the southeast London were impacted, but other locations, other regions, other cities, where it is more affordable and prices are still, relatively fair and reasonable, they weren't really affected as much because people could still buy there and still rent there. But look, the UK economy, so far what we're seeing, inflation coming down, we're seeing, wages rise, we're just seeing the cost of living getting easier. So the economy is stabilising. We're seeing the Bank of England reduce the base rate. So there's a lot of positivity within the property market at the moment. So that does feed into the property market. So the property market does feed off of the economy. So we have seen some, real good, sturdy, solid impact from the UK economy into the property market. It breeds confidence having the economy in a good place. Confident people will be in a position to want to buy. They don't need to sit on the fence as much and wait to see what happens. It's looking relatively steady at the moment, and that reflects in the property market. The property market is having house price inflation at a steady level. When we're looking at the house prices, house price growth at the moment, and the rental market is steadying as well in terms of rental price growth. Still growing at a very good level, but that is steadying, which is, again, good to see. So overall, the UK economy has had a positive impact, in my opinion, on the property market, and long may that continue. Right, next one. Where is the best area to invest in the UK? Okay, now, I mean, it's a question we get all the time. So I'm assuming that's from a listener. So the best area to invest in the UK. Okay, I'll try and answer this as best as possible because look, it does depend on the investor. There's a lot of variables, but if we use just a blanket average, for example, I think if you go by region, you've got the Northwest performing very well, and in the Northwest we have cities like Manchester, Liverpool, Preston, to name a few, performing very, very well. So, I'll be looking at those cities where there's good regeneration, steady house price growth, rental growth, high demand. That's where I'd be looking at. Then you've also got the Northeast, which is really now, taking the regions by storm as well, and catching up in terms of growth and positive rental growth and price growth, along the lines of the Northwest as well. So that's like Newcastle being the major city in that region. So they're the cities that I would be focusing on. Now, where's the best? It just depends what you're looking for. If you're looking for good, aggressive growth, I would stick to what I usually say. So I'd be looking at Liverpool in the Northwest because prices are lower there than the likes of Manchester. There is good growth potential there because of that. There's a bit more headroom for house price growth to be a bit more aggressive, and rental price growth as well. I'd also, if I'm looking at growth, be looking at somewhere like Newcastle. You've got the new owners of the Newcastle Football Club. The amount of money they're going to be bringing into the economy, and Newcastle is going to be massive. As a city, it's the major city in the Northeast, and it is a great investment location. I think it's overlooked sometimes, but when you look at the data, very, very strong growth there. The Northeast as a region is performing strongly, and Newcastle tends to be, the real catalyst for that. So, yeah, I would say by region, you're probably looking Northwest or Northeast, and those are the cities that I would focus on. If I'm looking for, maybe I'm a bit risk averse, my risk appetite isn't as high, I'd probably be sticking to like my Manchester. Be looking at a location in Manchester city centre or just outside the city centre where, there's been solid growth over the years. I can see the regeneration that's already taken place. I can see the demand there, and rental demand is very, very strong. And the growth is just, it's not as aggressive as those cities I mentioned, but it's nice and stable, and you can see it continuing on that way. So, if I've got less of a risk appetite, I'd be looking at Manchester still. I still think there's some good opportunities there. But if I'm looking for nice aggressive growth, and I really want to focus on that, I'd be looking at the likes of Newcastle and Liverpool. There's lots of other locations, but as I said, that's just not a simple answer. But actually, on that point, Savills just released a new updated mainstream capital growth forecast, and they've actually upgraded their forecast. So the Northwest used to be, just over, I think it's 28.2% or something along those lines. They've now upped the forecast for the Northwest to be over 29%, and the Northeast over 28%. So I believe that shows that the big players out there, like Savills, JLL, Knight Frank, they're looking at the property market and they're looking at the outlook, and upgrading their forecast is a good sign. Okay. Sorry, I couldn't be more committed on that question. It is a great question, but as I said, there's a lot of variables to consider when looking at that. So I can't just give you a one city, one location answer. Are UK property prices in a bubble? And if so, will we see a major correction in 2025? In short, no. UK prices aren't in a bubble. A bubble's usually going to burst when there's something which is going to be the pin to burst it. The last one we saw, the financial crash. That was people over leveraging, people not being able to afford. Lots of bad situations there, which people could see on the horizon were leading that way. But with the property market at the moment, the prices, especially right now, they've steadied. So you're not seeing like unsustainable growth and a catalyst for that, which then lead to a burst. We're not seeing that. We're seeing the market actually stabilise along with the UK economy. So I don't believe we're in a bubble, and so I don't believe that prices are going to burst and there's going to be a major correction in 2025. I just see it being steady for the next few years and onwards, hopefully, and it being a nice, settled, stable market, which we like for property investing. As I always say, it's more predictable and easier to forecast when it's like that. Okay. With rising interest rates, are buy-to-let properties still a viable investment for average investors? Yes. So the interest rates have risen. They actually have risen slightly since the Bank of England base rate reduction, and that's a different conversation. But they're still coming down and a lot better than they were a year or so ago. So that's positive. With the interest rates being at a higher level, for the average investor, that isn't an issue. Look, that is what it is. You have to deal with it. So it's all about, making sure you're buying an investment correctly, doing your numbers correctly, making sure you're not over leveraging, you're not over committing, and you can do it in a manageable way. So, whether that's leaving an extra pot of money in the bank, so buying at a lower price maybe and having a rainy day fund or whatever that may be, maybe even putting more of a deposit down to bring the interest payments down, because you'll be borrowing less. So there's ways around it. So investing correctly and wisely is the first thing I would say, which will enable the average investor to continue or start investing in the property market. And then also, look, I always say on the podcast to clients I speak to anyone I speak to about the property market, me personally, as I'm in the property market for the long term, I'm looking to hold the asset. The way I see it is if I can invest now in this market and I can buy a property and it be profitable, then that is going to hold me in very good stead for the future to come, because it means that's only going to get better and better and better. If you can make money in this market where interest rates are high, property prices have been rising, then that is very, very good. Because when you're holding that asset over the long term, remember, you're securing it today's price. Over the 5-10 years, rental prices are going to continue to rise. That means your yield increases. And if you decide not to remortgage and you keep the same mortgage as well, because of inflation, etc., that the value of that mortgage technically it depreciates because inflation eats away at it. So there's a number of factors which mean, when you hold over the long term, today's market, one, shouldn't put you off as an average investor, and two, it'll put you in good stead for the future. So don't be put off investing. If you can invest now and make money, you're going to do very well over the medium to long term for sure. So that was a bit of a tangent there. Kind of went off on one, but no, in short, rising interest rates doesn't mean that you can't get into property investment as an average investor. There still is the opportunity to. Okay, next question. Has the government's tax policy made property investment unaffordable for middle class investors? Wow, I don't know where they get these questions from. No, that is a good one. So, realistically, the main tax changes that probably will affect the middle class investors, as it's put here, being unaffordable, is the stamp duty land tax rising from 3% to 5% for second home purchasers and landlords purchasing buy-to-lets. Now, it hasn't made it unaffordable. It probably just means you have to switch your strategy. You have to look at cheaper properties because that'll bring that cost down. The pool of money that you had to invest, you just have to manage that carefully. An extra 2% stamp duty on a high value property will eat away at that pot. So again, it depends on your circumstances, how much you're looking to invest. But no, I don't think that has made it unaffordable. I think it just means you just have to reassess your strategy, where you're looking and what you're buying, more from a price point of view, because look, stamp duty is the main sort of tax change from a property investment point of view that they've brought in. There wasn't really many others, so no, I think it's absolutely fine still. I don't think there'll be an issue. Okay, are short-term let properties, or everyone loves a short-term let question or statement, like Airbnb investments ruining local communities or boosting local economies? Okay. Well, good question. You see a lot of negative press about the short let properties, being in surplus, where like Cornwall, Devon, in locations where staycations are very popular. Across the UK, staycations are getting popular, and that goes from London to coastal properties. So that people will have their say on this. Now, what a lot of local residents say is the influx of people buying properties and renting them out on a short-term let basis is restricting the properties available for local residents, which is true. And I get that frustration because it pushes up prices, pushes up rental prices, and can be quite frustrating for local residents. But what I would say is, I wouldn't say it's ruining local communities, causing frustrations, yes, but I wouldn't say ruining. And when you then look at what it does for the local economy, if you're a business, let's say you're a local pub or local restaurant, a small sole trader maybe, a smaller business, and you're in one of these areas, I don't think you're going to be saying that it's ruining your local community, or you're, not doing well for that, because you're going to be saying, look, this is great. This is bringing customers here. This is helping with my business. This is helping boost employment in the area because we have to hire more people so that the businesses around it. So it can have a positive impact as well. So look, there's two versions, responses you could give to this. One as a local resident, one as a business owner, and one maybe looking to frequent these locations and holiday there as well. So, but look, I think overall, I see the frustration from local residents, but it does have its benefit to the local community as well. But if I'm a local resident, maybe looking to buy there or rent there, and I'm being priced out, or there's no properties for me to buy, I can see the frustration there. But look, I don't think it ruins local communities, and I do think it boosts local economies. Okay, next question. Is the UK's build-to-rent sector too dependent on foreign investment, and does it risk making housing unaffordable for locals? Is it too dependent on foreign investment? I wouldn't say it is. I think foreign investment definitely helps the build-to-rent sector, but I don't think it's too dependent on foreign investment. And does it risk making housing unaffordable for locals? Well, look, when you say housing unaffordable, that's going to be rental properties, of course, because it wouldn't really directly impact property prices realistically, or massively. What it will impact is rental prices. And would that make it unaffordable for locals? Potentially, yes. Reason being, these build-to-rent apartment blocks and developments, they're being built with the renters in mind. And with that, you'll see that they'll have great on-site facilities and amenities, like gym, concierge, mailroom, communal gardens, co-working spaces, breakout areas, coffee areas. They'll have great facilities and amenities. And what that means is that, the people doing the build to rent, whether it's these pension pots, big funds, or whoever it may be, building these blocks, that means they can charge premium rents. Now, they are a business at the end of the day. They are looking to obviously make profit, so they are going to push the rents up as high as they can. That will then spread out to other nearby properties, meaning local rents will naturally lift, in line with that as well. So I do think build to rents will have a factor in making housing unaffordable for locals. it's a natural byproduct of it. But on the flip side, these build to rents are needed. They're helping fill the gap for the need of these types of properties. They're building these developments, these apartment blocks, where there's a massive shortage of properties to rent and people need these homes. So kind of a double-edged sword there. They're helping to provide property in the market, but at the same time, they are going to be, pushing up prices of rental properties as a byproduct of that. So yeah, hope that answers that okay. Bit of a diplomatic answer from me, I think, that one. I'm being quite diplomatic on this. So, yeah. Okay, next question. Will the trend of working from home reduce the demand for city centre apartments, making suburban and rural investments more lucrative? They will reduce the demand for city centre apartments, but I don't think enough to make a dent. Because look, working professionals, maybe people in that ease, comfort, logistically, are always going to want to be in city centre. No doubt about that. We saw that as a prime example in London. When the pandemic hit, people left London. They searched for more space, so they left the city. As soon as everything got back to normal, people flooded back to the city, and it's kind of back to normal. So I think that proves that there will always be demand, a massive demand and appetite for city centre apartments. That said, I do think, the trend of working from home, this remote working and flexible working, is actually giving the spotlight on these, suburban and rural locations, and opening up opportunities for investors to invest there and do well. Because while this is fairly new and hasn't fully been established, it's still taking place now. It means you can get in at this point, and because you'll see more and more demand rippling out from the city centres into these locations, because people can work remotely and maybe they're in the office once a week or once a month, a couple of times a month, wherever it may be. There will be people that will naturally be looking for these locations, as there always have been, but probably more so now. So it does mean there is an opportunity there, picking the right location, a commuter belt location, or locations where that type of demographic is going to be pulled to, whether that's to rent or buy a property. It is an opportunity to make more money and be more lucrative. So I do think that trend will definitely lead to that. But what I don't agree with in that question is, it will reduce the demand for city centre apartments, but I don't think, that's something to be hung up on, because I don't think the demand's going to be dented that much, as it will always be there. Okay. Last question. Ooh, okay. Is investing in cities outside London, like Manchester or Newcastle, actually a safer bet than the capital in 2025? Okay. Good question. In short, yes. We've been saying for a long time here, if you're a property investor and you're looking to invest right now, don't go near London. The fundamentals and the performance of the market in London don't really appeal from an investment point of view. The numbers just don't stack up in London at the moment. London is the capital of the country and will always be a hub for people looking to invest. But at this moment in time in London's cycle within the property market, it's not the best bet. I do think the safer bet is outside of London, in cities like Manchester or Newcastle, because they are seeing stable growth, future room for growth. They're being forecasted growth. They're growing as cities in terms of the regeneration going on, the building going on there, the people actually moving to these cities. So look, between now, I think over the next 5-10 years, those cities are going to perform very, very well. And, as an investor, looking from a return on investment point of view, those are a safer bet than the capital city, in my opinion. London is, in my opinion, struggling. And the main reason being, not in my opinion, the data shows that The reason being is because it's unaffordable. Prices rose, wages haven't risen in line with that, and probably some time what's needed to buy, deposit wise or earnings wise in London is massively unattainable for the majority of people. The rental prices, what you have to pay to rent in London, it's a big chunk of people's earnings to rent there. So again, the rental prices are, really, really limited in terms of growth at the moment, because it's less affordable for people to rent there, and that's the same for house prices as well. So yeah, that's why the likes of Manchester and Newcastle, where prices are still affordable, both from a purchasing point of view and a renting point of view, means as an investment, you're going to be looking at those areas and see that there is more room for growth, like we're seeing. They've consistently been growing over the years. They continue to do so, and we can see with the affordability levels in those areas of cities, there's still room for growth as well, which is always good. So yes, I do think they are a safer bet than the capital in 2025. Okay, that seems to be all my questions. So yeah, if anyone listening provided those questions, thank you. I hope your question was answered sufficiently. And yeah, I hope I gave answers that added some value as well. That's been my take on it. That's been my input. And yeah, that's been me answering your questions. Thanks for listening, and I'll see you in the next one. Bye.